All right. Hello, everyone. Welcome to your live market check-in here with myself, Greta Wall. I'm your host, and I'm joined by David Prince, the leader of T3 Live's Inner Circle virtual trading floor. Hi, David. Happy Thursday. How's your day going so far?
Actually a pretty darn good day considering, a lot of extreme action, so to speak. So
Yeah,
pretty
definitely.
solid.
All right. The title of our stream today is NVIDIA earnings reaction. So we'll just get right to that because that is the latest news for the market. NVIDIA reported earnings after the close on Wednesday, so last night. It was a beat. It was a good guide. The guide was really big. And so the initial reaction was stock up. Now, stock down. So give me your reaction to the report and what you think about the market reaction so far when it comes to those numbers.
So I think maybe if I tell you what we did, going into the print, it'll give you good context.
Yeah, definitely.
I had some stock from low 170s, and then to add a little alpha into the print, we bought 192.50s when it was, like 180s. I don't remember exactly, but 187, 188, that sort of thing, into the print, 192.50s and 200s. And yesterday, it hit a level that it just can't seem to get through prior to the print. And that's 193 and continued higher. And this is all during yesterday, during normal trading hours. So I said, okay, we know the template. The template is they're going to do fantastic. They're going to give great guidance. And how the street responds is really the question. The question is not really how they're doing or how their guidance is. It's going to all come down to how does the street receive it, right? Is this something people are still willing to buy? Mainly institutions, because that's who moves stocks. And we've seen a lot of institutions de-risk out of NVIDIA the last few quarters. You can just look at all the filings. So I said, listen, I haven't seen NVIDIA in a long time do a whole lot of nothing for 4 months. So if there's ever a time it might gap and go, this is it. But based on the last couple of quarters and the fact that memory is very much the new alpha trade that everyone's so focused on this year, I can't give you any guarantees. So I had a big profit in 192.50s. I took them all off. And I took a little bit more than half of my 200s off and said, all right, we'll play with the house money on the rest. And let's hope I'm pissed off and it goes to 212, right? That I sold too much. Yesterday, the print comes, traded a bit over 202. I sold most of my, or 201, whatever it was. I sold most of my stock. I still have a little bit. And I said, all right, numbers look great. Guidance is above the whisper, but we don't decide when stocks move. So people can ooh and ah about valuation being too cheap. Goldman's saying today it's 15 times next year's earnings. You got to buy it. But there comes a time where cheap is not always a good thing. It's people making a decision that they see better risk reward scenarios they believe in today. And maybe they'll change their mind. The way I likened it is I said, oil stocks have done phenomenally well this year, and that's with the price of oil going lower, simply because the market moved on to a new shiny toy, which is relatively cheap compared to the market up till now. Now it's been re-rated. And you know what? Oil stocks work, just like biotech became in vogue for 6 months and had one of its biggest moves in years, just like so many other sectors. So for now, the street doesn't care. Doesn't matter what we think or want. And I haven't gone back to it. I own a little bit of stock and I'll sit with it, but otherwise hasn't been a focus today. And clearly the street's not interested.
When it comes to this reaction to the NVIDIA report, obviously there's been some concerns lately about the AI trade. Is the AI trade a bubble? Is it over? Is the market moving on, etc.? NVIDIA was kind of like, okay, we're going to see what the market really thinks about the AI trade when it comes to NVIDIA's report. So what do you think the market is feeling about?
Well, I already know the answer. The answer is in stock prices outside of NVIDIA. The AI trade is very much fine. Today's is more like, hey, we're taking profits across the board. We're taking money out of present day winners and buying what, for the now is cheap, meaning software, which I'm sure we'll get into. But if you look at, let's go with CoreWeave. It's not even down $1. NASDAQ's down 368. Cypher barely down, Iron barely down, MBIS down 1.5%. So the stats suggest the AI trade, because that's the backdrop to the AI trade, right? And of course, stocks like Oracle. I haven't looked at Oracle today, but it's probably holding up. Where's Oracle right now? Oracle's green on the day. So the AI trade very much is proven to exist, but it may not be through Nvidia right now, right? That's that one day people wake up and say it's too cheap and I got to own it. But for now, the AI trade exists, but that doesn't mean the company that started the whole party, right? That is the backbone of the whole party. Doesn't mean it has to be a part of the stock price moves going higher. Today is definitely a day where people are taking profits in semis overall, and they're using this as a moment to ring the bell and take some profits in some crowded areas like Nvidia, like semis, and move on to maybe other stocks like software that people think have been thrown out the window.
Let's talk about software just real quickly. I know we have some people with us who are in your open house this week. So if you guys have any questions about what we're discussing here today, submit them and I'll make sure David answers as many as we can. All right, let's talk about software because it wasn't just Nvidia reporting yesterday. Some really important software companies reported last night, namely Salesforce and Snowflake, CRM and Snow. So what do you think about those reports and the reaction we're seeing in the market today?
So I guess it's always good to tell you via what we did in case there was something, because it's just
for sure
more straightforward. So on the surface, when you looked at both, CRM's guidance was a tad bit subpar given the stock price and the PE. Maybe it's not miserable, but it certainly wasn't a great guide. And the stock price went up for a minute and then straight down. And I said, we'll worry about that tomorrow. But I actually think it'll turn around, and it basically has a workday feel. And I said this is probably going to put a bottom in tonight or tomorrow, and it'll be a red to green trade, specifically after a conference call where Mark was so aggressive about, frankly, his market cap being too low, the earnings, that this was probably a stock that has at least short term put in a low. And then there was Snowflake. So we did nothing last night, which actually had probably better execution, gave decent guidance, and had a strong conference call. But prior to the conference call, I looked at the guidance and I said, given the stock's under fire, the whole group is, and this stock just gapped, it was like 25 points off lows of a couple of days ago, said there is zero shot it's staying here. I just want to remind myself where I did it so I don't make up numbers. So yeah, it was 179, 180. It was trading right there, and I said, there's zero shot, in my opinion, this stays here. So we shorted it after hours before the call. I frankly had to get ready for the Nvidia call. So I said, you know what? I'm going to take a quick profit. I think I made $4 or $5. And the rest of the chat, a lot of them stayed in for like 10 or more. But basically, I said, it's not good enough to warrant that size of the move. Because remember, it's not cheap like CRM. But bottom line, if you were to break everything down, Snowflake, maybe a bit better execution, but obviously not cheap. CRM, some issues, but so cheap, I think people are willing to give it a pass, especially after a really bullish conference call. On the whole, I told people don't make too much of today. The way we played it is I said, I'm not buying any software all week except for one name, CrowdStrike. For me, and some people will be like, it's expensive. And I go, it's expensive for a reason, because most people who understand business, including the CEO who was out screaming this week about how it can't be replaced and showing you what Claude says when he asks, which was that he can't be replaced. But anyway, the expensive ones are expensive for a reason, because they're not replaceable the same way a lot of people perceive CRM to be, and that's why it's cheap. So I always caution people to not go by valuation. It's not always a great way to buy stocks. But bottom line, we went with CrowdStrike. I bought early. I had to suck some wind. I was down 20, 25 points. And I added more, well under 350. I added like 346, 347, 350, 360. And today, and even the other day when it had bounced 15, I started selling. And then today I sold most, because I still see software under fire. And after like a 40-point rally, I said, I can't throw caution to the wind. The group is under fire. It did what I hoped it would do, and now I got a pare back risk. So that's what we did. So software was fine, and it clearly is a way to kind of take some money out of winners, rotate to some stocks that some people perceive or overdone to the downside. And now we got to wait and see. But I wouldn't say today is momentous. Momentous is the word I'm looking for. I wouldn't say like today is the start of a huge software rally, but there are some signs that it can go a bit higher. Like IGV, I'd want to see it above what most people call the 20-day. For me, it's the 21-day. It's a couple points higher. So it's the start of something. But if we back and fill a little bit towards lows of this week, I wouldn't be shocked either. There's no clear cut, like the bottom's in, bullish software. And that's kind of how I see things.
So now we're through like the big week, all the big numbers of earnings season, and all the Mag 7s and Nvidia reports late, but now we're through Nvidia. Still a few more reports to come, like Micron, who reports really late every season. It's kind of like the last report to get his Micron. But when it comes to this earnings season as a whole, when you look back on it and as we wind things down here, what do you think about the street's reaction to these numbers and some of the numbers that were released and what it means for the future this year?
None of it's surprising. I think it's put certain companies and sectors in their place. So we've learned that Mag 7 doesn't define the market anymore. That's clear. We've also learned that if you're spending most of your cash flow or you have to borrow to basically build out data centers, that's not a good thing. And you get penalized, right? So we've seen it time and time again, whether it be Amazon, whether it be Microsoft, whether it be Oracle. But the bull market still exists. What we saw is monster numbers from the Caterpillars and the Deeres and the Honeywells, and oil doing well, led by the Chevrons and Exxon. So what we've really seen is the biggest rotation in 3 or 4 years, where a new group of stocks are leading the market. And within tech, there is leadership. It's just more narrow, and it's all really about optical, Lumentum, AAOI, storage, right? Western Digital and Seagate, and of course, SanDisk, and memory, Micron. So what we've really found out is just it's not the market we've been used to for 3 years. It's not about Mag 7. It doesn't have to be about Nvidia, but we also are seeing tons of winners, which brings me to what I want to say. If you don't understand the market or diversification, which is not, I'm not big on diversification, but I get why it works for people. Look at oil, look at all these, consumer stocks that are working. You might think we're in like a bear market, right? We just saw a virtual crash in software. Software didn't pull back, it crashed. So I think you truly have to be educated. You have to look underneath the hood. You can't just look at the Qs or the SPY or XBI, right, or IWM and know what's going on. You have to be aware that there's a crash in software, that memory is going through a super cycle, and these stocks have had moves like we've never seen, that a lot of people question whether some of these copper wire guys, the CRDOs, the Asteras, are even going to really survive. Not survive, but their business is going to be eaten. And is it all about optical? And that's why the Lumentums are going on. So I don't remember a time where there's so many monster, like stealth bull markets and bear markets in the same stock market. And that's the best way to describe it.
It is the action is very sector specific, and you can tell like what is in vogue for the broader market at the time. It's very clear. All right, let's get to some questions. Again, there are some people here with us who are in your open house this week. Again, David is hosting a special open house for the Inner Circle, where people can get an inside look at what the room is. So the first question we got is from, his name is John. He said he's been trading stocks and crypto for 10 years, slow improvements yearly, but still learning, never options, hasn't learned. His account size 200,000, passive, not for bills. So if he wants to grow his account steadily and learn, especially options, is the Inner Circle a good room for him?
Okay, solid question. I didn't hear, is he full-time, part-time? Did it say?
Just says account size 200K, passive, not for bills, but been trading stocks and crypto for 10 years, but not options.
So I don't really like selling myself. So I'm just going to tell you what happens. I believe work should sell itself. So if you've been in the room, hopefully you already have made that decision for yourself. But here's what I say. I say picking stocks is not how people grow accounts, no matter what you hear. Money management with those stock picks is the difference between growing accounts. That's where we excel. That's where we define ourselves. when to be aggressive with risk, when to pare back risk, when to literally be a bit more concentrated because we have an edge in a stock. Now, when you hear these stories, a lot of, people ooh and ah on Twitter and show their account size and how it's gone up many hundreds of percent. Not really big on that stuff. But what I will tell you is all the people that generally do that do it because they find their lane and they really excel within their lane. So what I mean is when we have an edge, whether it be SanDisk this year, Nvidia prior to this year for 2 years, whether it be, literally there wasn't a 30% pullback where Nvidia overnight did not become 50% of my book. These are the type of situations that can take a $200,000 account up 2, 3, 4, 5x. So the best example I can give you, and there's a lot of them, for the lack of being modest, is when April came, there was some aggressive buying by us, but there were people who had tripled their account by the summertime. Because I don't care about making money daily or weekly. I care about making money when opportunity comes up. So that means swinging the bat on a stock sell at 7 and saying, this could be up 50% on the week. That means swinging the bat on Nvidia at 86 through 90. That means telling people that Immunome can change your life under 10. So sure, but here's the caveat. If you're not listening, if you're not using EQ, like I always tell people, it's not a chat, it's just a follow. Like you have to know there'll be certain stocks where I'm 6 months out and I'm a slow swing buyer. And there's certain stocks I think have a catalyst today and are going to make money. So if you're good and you pay attention to details and you listen to the AM call, and frankly, you are humble, because I believe, in fact, I know I have guys on the chat who run hundreds of millions of dollars who are humble and kill it. And I have guys who run 300 grand that all day talk about how good they are and talk about every trade they did, and they generally make less money. So if you're humble, if you listen, if you're good with details, then you can kill it. That's the answer.
All right. Amber said he has signed up for the room. So been a good week for him getting an inside look there too. All right. This is a little more related to your strategy. And so I think it's important to talk about. Krishna asked, when DP or Rick say down to a trailer on puts or position in general, how wide are they setting your trailing stop, percentage based or fixed dollar amount? I know you don't use stops. So just explain what that means when you get down to a trailer and how you use that strategy.
Rick definitely uses stops more than me. For me, a trailer is usually more 10% or under. And then specifically, I'll have a stop in mind, not literally put in, but I'll be like, if this breaks this level, if this breaks the 21-day, the 50-day, that means I should get out. And the reason is because, well, you can see the gray. I've been around, and too many people get stopped out, and then you see stocks go back above, or a short, and you end up covering, then goes back down. So I really always know. I don't believe in taking trades unless you know where you're wrong, but I don't just put in a stop. In terms of trailer, it just means I'm down to 10 or 5%. And finally, that how small I get is always defined by how close we are to the target, or if I think maybe the stock's gotten overpriced, whatever it will be. But sometimes people will ask, well, how do you decide? I'm like, well, if I think there's 100% more upside, then I better still be holding 80% of my position. If my target is 85 on whatever stock and it's at 84, I want to be out of 80, 90% of it.
I think what's important about your strategy with like stocks and stuff is you're not setting those levels for yourself based on a percentage of a loss or a dollar amount. You are setting based on very specific levels on the chart where you think something is broken.
And certain stocks can be broken, but bounce a lot. Let me give you an example. I really mean it, but you have to be kind of around and know things. So if you're around and know things, you know that CrowdStrike has already crashed on its own due to an outage that really almost took the country down. And we saw the stock get crushed. And then we saw it go up 200%. And we reminded ourselves, oh my God, the world runs on CrowdStrike and the US without it doesn't run. So this time around, as software got killed, I said, I got to buy CrowdStrike. We bought some at 400, went as low as 370. Then it bounced to 425, 420, actually bounced to 430. But at 425, I said, you know what? This software downside, there's more to go. So we got out. And this week, the world, the wheels come flying off and software crashes, and so does CrowdStrike. Well, now CrowdStrike is the type of stock I am okay being down 5, 7, 8%, because frankly, I understand it. I have a strong thesis about why it's going to exist regardless of AI. And I think the growth trajectory is only going to improve. So I'm willing to ride that and buy more and actually make a lot of money, because that's how the stock trades. It trades wide and to some degree wild. And then there are other stocks that are simply broken equities that every time they make a new low, there is barely a bounce, and then it's going to make another new low. So the point is, maybe 5 or 10% of the equities I buy, I understand their personalities, and they won't follow a chart. They won't like just make it easy for you and like go beneath the 50-day and then not go back above. They'll go beneath, and then it'll be like literally a roaring bull market the next day. So I do get to know the personalities of the stock, how they trade, rather than just use a chart and make kind of blind assumptions based on just a few lines.
Great. John, who asked that first question, he asked what would be the best way for him to start learning options in the room.
That's something we have to chat about on the side, because we are a pretty advanced room. It's not like a teaching room. I'm going to teach you options. So I'm going to be frank with you. That would be like a guy like Rick. I would like, not a big shot, but I'm being honest. I don't have time to go to the bathroom half the time. So I have no time to do that, but I'm sure Rick probably could help you with that if you talk to him on the side. Options are important, especially when you're dealing with mature people, because they use options as a way to mitigate risk, improve upside, rather than just being willy-nilly into earnings reports and owning stocks. So I suggest all people learn options, because you hear about options as, a way to get rich. Sure, you can have great leverage and make lots of money, but I also think what's important about options, it's a way to mitigate risk. There's a guy on the chat who's still learning. I don't know why, because he should be pretty good by now. But anyway, he's still learning. Maybe it's not his full-time job. Yesterday, I found out half of his account was Nvidia going into the print via stock. And I said, you shouldn't be on my chat if you do that. It wasn't a big account. It's not like the guy's running millions and millions. I said, that's like the dumbest thing I ever heard. You need to, and by the way, he was up like 8 or 9 points. I said, you take some profits. And moreover, you either get small in the stock, or a much better way to mitigate your risk and not give your gains back is say, I made X amount in the stock. I'm willing to take this amount of money. I'm going to put it in upside calls, and this is what I'm comfortable losing. And by the way, don't use all of your gains, use a partial amount, because Nvidia has consistently disappointed the last couple of quarters, even on great numbers. So my point is, like, yeah, you need to learn options, because it's not a way to get rich. It's a way to actually manage money. And in fact, some people today, we have CrowdStrike and it's killing it, and we're up, and some people want to hold it longer. So we're selling upside calls against the position so we can hold the stock longer. So yes, you should learn. Rick can help you. Remind me on the chat.
All right, great. And he has already joined the room, so we'll definitely, Amber can also, I'm sure, help with that as well. Frank asked if you would recommend having portfolio margin to be able to short.
Unless the rules changed, I never heard of you being able to short. I don't mean to laugh at him. Can you short without having margin? I don't think you can. I'm old, so things go under my radar, but I'm pretty sure that still exists. You cannot short without having margin ability.
I think so. Yeah.
I don't make the rules. That's the SEC, but I'm pretty sure that's how it is. Some of my biggest trades, if you're asking about me, SMCI short. We've had some.
You definitely should be able to short whatever you need to be able to set up, because it is a big part of trades.
I know people that have, changed their lives forever via shorts that we've done. I mean, I'm kind of a good short. So yeah. But also, if you're a tiny account and you don't understand shorting, no one should short till they really understand what the hell it's about. There's a lot of risk, but yeah, you can't do it without margin, and one should know about it.
All right, this is a good question. And I hope I'm saying your name right. Daria asks, she said, I have found the AM call super helpful, but for someone who can't be active in the room full-time, given a full-time job, do you think Inner Circle is good for a passive person? I know there are lots of members in the room.
It's well known. Right. There's like, I have like a hospital in the room. I got like 50 doctors and surgeons and brain surgeons and radiologists, and they do particularly well. Remember that first fellow's question? This is rhetorical because you can't answer me live. And I said, as long as you're okay with details. So yeah, like I have a buddy named David who's from Houston, just recently moved to Jersey. He's a radiologist. He checks in with me. It's like, I might have missed this. Should I do this? Should I put in a sale here? Because I'm long lots of Fastly with you in the 16s and it's 19. And we discuss things and plans. So the answer is yes. If you are an anal person who pays attention to the details, you can do sometimes more or better because you're not in front of your screen over trading.
And the morning call is really key to that, to understand like what your best ideas are to focus on.
I'm not big on reacting to the market and just making up trades all day. We do a lot of planning. If X happens, we do Y and that sort of stuff. So yeah, I mean, there's a ton of funds and full-time ladies and gentlemen, but there are plenty of people who are, have full-time careers and do it.
All right. Sam asked, how do you recommend growing a smaller account to reach the 100K minimum to be able to join the room?
That's pretty basic. It's to not shoot for home runs. It's to take losses early and quickly, which is the same thing. Sorry about that. And most importantly, to look to hit several base hits and doubles. If you look through time, you don't have to be hitting home runs to grow your account by several multiples. I mean, 10, 20, 30 times by just hitting consistent singles and doubles. And most importantly, admitting when you're wrong, not turning a trade into a hold. That's how to do it. And to constantly learn about maybe not value investing or trying to do things that are overly sophisticated, just figuring where's money flowing? What are the best setups? I'm going to do that today. Oh, there's nothing today. I'm not going to do it. I always say these small accounts make more money by doing less. So it's doing something great and then doing less in between. And that's how you grow a small account into at least a larger account.
All right. Dan says, I lost too much money in the last month. I had poor risk management on software and healthcare. It has been a hard month for a lot of people in the market. So what do you suggest to, get back on track and where to focus?
Sure. I'm from New York, and I'm kind of direct. I would suggest, unless you can admit where you're wrong and take losses early, you should quit the business and do something else. If you can change that, in other words, admit when you're wrong early and live to play another day, I believe that's kind of everything in this business. You hear it, but I'm going to tell you. So again, just so you understand, how you handle adversity, how you handle a loss will define your career far more than your gains. That is not from a book. Yes, a million books write about it, but that's just simple fact. That is what's going to lead to longevity and consistency. So I would say, if you can understand why you didn't take those losses, if it was an emotional decision and you can change that, you can do great. I would also suggest reading things like The Disciplined Trader, Reminiscence of a Stock Operator, certainly Trading in the Zone, to better your head. So the next time you have to confront a loss, you can take it, because I'm guessing there was an emotional response there that made you maybe say, well, maybe, kind of, sort of, I hope. And you don't want to say things like that. You want to take a loss, not let it define you, and move on to the next day. So if you can do that and you read some of those books, I think you'll be fine. If you have a problem doing that, then the nicest thing I could say to you is quit the business and find another job before you destroy your life.
All right. And then this is just more logistics of the room question. Krishna asked, what are the general hours the room is active during the day? How late do you typically stay on into post-market? Really depends on the action, because you could be on at midnight if there's something happening.
That's not how we work. We're about opportunity. So I've been on a Sunday all day. I've been on at 12 o'clock at night shorting gold. So generally we're trading pre-market, after hours if big things are going on. It's earnings season. So just assume certainly active during the day. And if pre-market there are things to do, I'm doing it. Rick, Kira are doing it. So it's an all-day affair. And after hours, Sundays.
I'd say an important thing for the inner circle is having the app, because then if David's on randomly at 7 p.m., you get an alert, you see it on your phone. and you can.
I want to make it clear, on your average day, you're not going to get dings about me doing crazy stuff at 12 a.m. But when tariffs are occurring during COVID, during these momentous events, or the yen trade, I mean, a lot of the money is made. Those who are willing to step up in the greatest moments of fear, like the other day, silver was crashing. It was 7:45 p.m. and I'm buying 62, 60, 59, 58. By the next morning, it was 67. I wouldn't be buying it then. I knew where it was the night before. So after hours, when there is volatility and opportunity, we'll be around.
Yeah, for sure. All right. And then I know we got to wrap things up here soon, but Jeremy asked, when you say take your losses early, do you have a quantitative metric that you use, or is it more about
No, I believe that's idiotic. It should be by the individual idea. No idea is the same. The minute you are able to look at each idea and give them credibility unto their own, you'll do well. If you just take if I'm down 5%, I'm out. No, right? So I financed a company called Immuno, and I explained to people, if you're a small account, you shouldn't buy it. It doesn't trade even 1 million shares a day. If you're a larger account, and you can't stare, you don't have to stare at it, the upside can be 5, 10, 20 times one day. So at the same time, because it's biotech, you might find yourself at certain points in time down 20, 30%. Let's do the math. There are people that bought that stock at one point last year at 8. During April, it hit 5. I'm not a mathematician, but that's over 50% of downside, right? No, 8, 4, so not quite, but we're almost at 50%.
Yeah, pretty much.
So call it 40%. Bottom line, I bought more there, right? At one point a few weeks ago, it was 28. So it's a biotech. I know management, and I'm a big believer in the company. Then there are other stocks. You should never ride down 30%. It makes zero sense because the upside is only maybe 20%. If the upside is only 20%, you ride it down 40%. Well, then that's an idiotic trade, right? You better get out of it. The math doesn't work. So I don't believe in being robotic. I believe in weighing each idea, deciding what your target is, area, what's your reward, what is the potential risk? That's the first thing I look at. What is the potential downside? Weigh them, and that's how I decide when to take a loss. So, example, let's say you bought a ton of CRM, and you envision there's no way this could go under 200, and it's under 200, and you don't see it bouncing short term above 250. Then you better be out of this at 199. Not today, because we know it got to the 170s. So you always have to look at worst case scenario and then weigh it against the upside. And bottom line, 90%, 99% of the traders out there should never let something be down against them more than 20%, even less, but 20%, because you start to have to see a stock go up 40 or 50 or 60% just to get even, right? The larger these percentages go. But each stock should still be weighed individually. Like, what is that risk and where's the reward? Is it 5 times the risk? Okay, I might give it more room than your average stock.
All right. Before I let you go, David, I want to get your opinion on what you are looking at in this market. What do you like? Any setups you like post Nvidia as we look toward
better off telling you what I said at
or what you don't
611, 612 on the Qs. I said you're getting a flush in memory, you're getting a flush in storage, you're getting a flush in semis, you're getting a flush in Nvidia, which is literally losing for a moment the 50-day, the 21-day, although we've bounced a bit. And well, crypto, which looked great yesterday, all of a sudden is pulling back. And all the money is only going to a couple places, a little bit financials, but mainly software. And that was just deeply oversold. And this could be just a cute bounce. Step the hell away, let things settle, and take a deep breath. Here are some of my favorites on pullbacks. Immunome into the 100-day, near 20. Been riding it a long time. It's early in the story. This has a lot more upside. Fastly, we were very aggressive in the 16s today. But frankly, after, not today, the other day, but frankly, after a move from like 1650, 1660 all the way to above 19 earlier today, I got pretty small. It's like almost a 20% bounce. Would I buy it again? Absolutely. The stock has come a long way. It needs to settle, and the chart's a little messy here. So I'd not look till under 17. Embracing agentic AI, a really different quarter than they've reported in many years, and very much a front and center name. Memory and storage are backing off today. they might need a break. Stocks like Lumentum have gone like that. They were real stretch from the 8-day. You might look for it to catch into the 21-day, but leading optical play, it's not going anywhere. Lumentum's still a buy on pullbacks. And then you want to see, how does a stock like SanDisk deal with the 21-day? But if you ever get a real aggressive pullback, I don't think the story's over. At the end of the year, I think you got to be careful as maybe supply starts. At least if there's rumor supply is going to meet demand, I think these stocks could be in for a bigger correction. In the meantime, given their earnings power and the supply shortages, I think any aggressive pullbacks in Micron or SanDisk can be bought. But aggressive, I mean like the wheels fall off for a moment. Everyone's worried the 20-day broke. All of a sudden, a SanDisk is 545. I'm picking that price because that's where the deal was done, to 500. I think you buy it. I don't think you overthink things, because they still think that can't be fixed, the supply demand. So there are some basics. Financials don't excite me. JPM lost the 200-day the other day and is back above. But in general, they're all much more expensive than they typically have traded over the past decade. They're trading, something like JPM's trading like 2-3 times book. They've all been re-rated. I don't see a lot of upside there. Biotech's had a big run. I would look underneath the hood for stocks like Immunome rather than blindly buying XBI. Fastly, a new superstar. And then finally, ENPH, Enphase. Beautiful chart, but pulling back after a disaster by First Solar. I think it's the beginning of a much bigger turnaround. Really had some very, very different news for us this quarter than they've had in about 2 years. So I would look at Enphase on pullbacks, ENPH.
All right. Thanks, David. All right. So for everyone who is with us here from the open house, Amber has put a link in there in the chat if you would like to join. For everyone who's with us from YouTube and Twitter, you can go to t3live.com/DP if you have any interest in working with David in the Inner Circle. It's a free application, just a few questions, and you can see if you qualify. David, have a great rest of your week. Thanks
you
so much for your time today.
Thank you very much. Have a great day.